Welcome back to the ProTicker Podcast, your Friday morning edition covering major financial magazine
Oh,
headlines.
yeah.
Today, we're diving into the global economic landscape,
All right.
exploring recent data and expert opinions on where things are headed. We've got a stack of insightful articles from the Wall Street Journal,
Okay.
Barron's CNBC, and MarketWatch, and let me tell you, they paint a pretty fascinating picture with both opportunities and challenges on the horizon. Are you ready to navigate the latest twists and turns in the financial world?
I think so.
Let's dive in.
Let's do it.
Okay, let's start with a topic that's been making headlines, the global growth slowdown.
Okay.
The Wall Street Journal reported that the European Union is predicting slower growth in the Eurozone for 2025. They've revised their forecast down to 1.3% growth,
Right.
from a previous estimate of 1.4%.
Okay.
Now I know what you're thinking, 0.1%.
Yeah.
That's barely a blip.
Right.
But trust me, in the world of economics, every fraction of a percentage point can have ripple effects,
Oh, absolutely.
especially when we're talking about major economies like the Eurozone.
Yeah.
What's interesting here is that the EU is pointing to some very specific risks that are contributing to this slowdown.
Oh, really?
What are they?
Well, according to the Wall Street Journal article, they're particularly concerned about a potential trade war with the U.S.
Oh, right. All the talk about tariffs on European goods.
Yeah, that's still a very real threat, and it's weighing heavily on their economic outlook. On top of that, they're also grappling with the growing impact of climate change, which is leading to more extreme weather events and disruptions to agriculture and industry.
So it's a combination of geopolitical tensions and environmental challenges.
Right.
Not exactly a recipe for economic stability.
No.
And speaking of slowdowns, the UK isn't faring much better. Their GDP growth also missed expectations in Q3, coming in at a meager 0.1%,
Oh, wow.
as reported by the Wall Street Journal. And if we connect this to the bigger picture, a global slowdown can have a domino effect across all sorts of industries and markets. It's definitely something to consider as you think about your own investments
Yeah.
or the companies you follow.
Yeah.
How might a slowdown in Europe or the UK affect those areas?
That's a great question for your listeners.
Now let's shift gears and head east to China.
Right.
The Wall Street Journal reports that while there are some signs of improvement in their economy, economists are warning that more help is needed.
I see.
Industrial production rose 5.3% in October, retail sales popped higher by 4.8%,
Okay.
and investment in fixed assets held steady at a 3.4% increase. So on the surface, things seem to be moving in the right direction.
Yeah, but it's not quite as rosy as it might appear.
Well,
Those
yeah.
numbers might sound decent, but they're actually below expectations. Plus, there's a looming threat that could derail China's recovery.
What's that?
The potential for new tariffs from the U.S.
Oh, right. The
Right.
trade war drums are beating again. I almost
Yeah.
forgot about that. I think it was in the Wall Street Journal or maybe CNBC. It was one of those articles, but it said, Donald Trump has said he'd raise tariffs on all Chinese imports
Yeah.
to the U.S. to a whopping 60%.
Wow.
60%. That's massive escalation.
It is.
Do you think he'll actually go through with it?
Well, it's hard to say for certain. The situation with trade negotiations can change quickly, but what's fascinating here, regardless of whether these tariffs are enacted or not, is the impact such a move would have on China's economy. Their economy is heavily reliant on exports. So a trade war with the U.S., especially one of this magnitude, could be particularly damaging. It could force them to take drastic measures to stimulate domestic spending and find new markets for their goods.
It's like a high-stakes game of economic chess, isn't it?
It really is.
And speaking of trade wars, it's not just China that's in the crosshairs. The Wall Street Journal also mentioned that Trump has proposed tariffs on European goods,
Right.
which could have far-reaching consequences for the entire Eurozone.
Absolutely.
Wall Street Journal even quoted the Bundesbank president,
Okay.
who warned that Germany, Europe's economic powerhouse,
Yeah.
could lose a full 1% of its GDP
Mm-hmm.
if these tariffs go into effect. Alliance Trade also projected some pretty substantial export losses, with the UK potentially losing £11 billion, Germany facing a $24.5 billion hit, and Ireland looking at a $13.3 billion loss. Those are huge numbers.
They are.
It seems like everyone is bracing for impact. And you know what they say? When the U.S. sneezes, the world catches a cold.
That's a good one.
It really highlights how interconnected the global economy is.
It does.
It makes you wonder, though, will a stronger U.S. dollar be enough to offset the impact of these tariffs? And what other factors might come into play? I mean, there's got to be more to the story than just tariffs, right?
You're right, there are always multiple factors at play. Currency fluctuations, domestic policies, consumer behavior, and even unexpected events, like say a pandemic,
Right.
can all influence the economic landscape. That's why it's important to weigh different perspectives, consider all the potential outcomes, and do your own research before making any investment decisions based solely on trade war rhetoric.
Great advice. Okay, so we've talked about the doom and gloom of slowdowns and trade wars, but let's shift to a more positive note.
Even amidst all this economic uncertainty, there are some bright spots, particularly in the retail sector.
Oh, yeah.
Barron's had a great article featuring insights from Marie Shore, a senior equity analyst at Columbia Threadneedle Investments. She pointed out that some retail categories are thriving even with everything else going on.
Interesting. So who are the winners?
She highlighted Costco, Walmart, TJX companies,
Okay.
and of course Amazon,
Of course.
as some of the winners in this environment.
And why is that?
Well, according to Shore, their success boils down to a few key factors: value, convenience, and strong supply chains. In times of economic uncertainty, consumers tend to gravitate towards retailers who offer the best value for their money
Right.
and who make their shopping experience as easy and seamless as possible.
Makes sense.
So those are the magic ingredients for retail success in these turbulent times.
Value, convenience, strong supply chains.
Got it. So while some parts of the economy are struggling, others are adapting and thriving, it seems like there's always opportunity somewhere if you know where to look. The beauty of the market.
Speaking of dynamic and evolving, let's move on to the stock market.
Okay.
The big question on everyone's mind is whether the current rally is sustainable.
Yeah.
MarketWatch featured an analysis by Tom DeMark, a well-known technical analyst, and he issued a rather chilling warning.
Oh, what's that?
He's actually predicting a potential market top. And get this, he's drawing parallels to the market crash of 1929.
1929.
That's a scary thought.
It is.
So what's DeMark basing his prediction on?
Well, he uses a trend exhaustion approach,
Okay.
focusing on specific patterns of 9 and 13-day or week moves in the market. He argues that markets tend to top out on good news, and that's what we've been seeing lately. A lot of positive news driving the market higher.
So basically he's saying the market is getting tired of going up,
Right.
and it's due for a breather or worse, a big fall.
And he has some specific price targets too, right? He does. He predicts the Dow could top out at 47,045, and the S&P 500 could hit a ceiling at 6,118. He's also particularly cautious about NVIDIA, which is reporting earnings soon. He sees significant downside risk for that stock.
So a potential market top warnings of a crash and NVIDIA in the spotlight, that's a lot to digest.
It is.
What do you make of all this? Is it time to panic and sell everything?
Well, it's certainly a lot to consider. DeMark has a pretty impressive track record. But even the best analysts can be wrong. It's important to remember that market predictions are just that, predictions. They're not guarantees.
True enough.
Yeah.
But it's definitely food for thought, especially for those who might be a little too bullish on the market right now.
I agree.
Okay, let's wrap up this part of our deep dive with a look at the Oracle of Omaha himself, Warren Buffett.
All right.
The Wall Street Journal had a couple of articles about his latest moves.
Oh, yeah.
It seems even as he's been building up cash, he's been making some intriguing investments.
Interesting.
The Wall Street Journal reported that he took new positions in Domino's Pizza and Pool Corp,
Interesting.
which sent those stocks climbing in after-hours trading. It's always fascinating to see where Buffett is putting his money,
It is.
especially because people often try to glean insights from his investment decision.
They do.
So what do you think these moves tell us?
Well, I think these particular investments reveal a couple of interesting things about Buffett's current thinking.
Like what?
First, despite some economic headwinds, he seems to see value in consumer-focused companies. Domino's, with its strong brand and delivery network, fits that bill. And Pool Corp, as a supplier for home improvement, could benefit as people continue to invest in their homes.
Interesting. So he's not letting the broader economic anxieties completely dictate his investment strategy.
Right.
He's still finding opportunities in specific sectors.
Exactly.
Second, these moves could signal that he's looking for opportunities in sectors that haven't fully participated in the recent market rally. Both Domino's and Pool Corp have lagged behind the broader market this year.
Oh, I see.
So he's potentially buying low, hoping for a rebound down the road.
Classic Buffett.
Always looking for the undervalued assets.
Exactly.
It's also worth noting that he also trimmed his holdings in Apple and Bank of America during the quarter. What might that signal? It's certainly something to keep an eye on as we navigate these interesting market conditions.
Yeah, very interesting.
It's like he's playing 3D chess while everyone else is playing checkers.
He's always a few steps ahead. While we're on the topic of market predictions,
Yeah.
I think it's worth digging a little deeper into Tom DeMark's methodology, which we briefly touched on earlier.
Yeah, that Market Watch article about his countdown approach definitely piqued my curiosity.
Yeah. It sounds a bit ominous, doesn't it?
It does have a certain dramatic flair to it, doesn't it? Essentially, what DeMark does is look for specific patterns
Okay.
in price movements that suggest a trend, in this case, the upward trend of the market, is nearing exhaustion.
Yeah, so it's like a clock, ticking down to a potential market reversal. That's a great way to visualize it. And based on his analysis, both the Dow and the S&P 500 are currently in this countdown phase, meaning they're getting closer to that potential top.
Okay, so how does this countdown work? What kind of moves would trigger a sell signal according to his model?
Well, according to the Market Watch article,
Okay.
he says that for the Dow, it would take 2 more all-time highs to trigger a sell. For the S&P 500, the countdown is a bit further along, but still requires a few more strong upward moves to reach that critical point.
So it's not an immediate red alert, but definitely a yellow flag to watch out for.
Right.
Especially for those who are heavily invested in those indexes.
Exactly.
DeMark acknowledges that there's always the possibility of good news, continuing to propel the market higher. But he argues that once that buying interest is interrupted, even for a short time, subsequent rallies are likely to be short-lived.
It's like a game of musical chairs. Once the music stops, you better find a seat quickly or you'll be left standing.
That's a fantastic analogy. It really highlights the importance of being aware of these potential turning points.
Yeah.
And having a plan in place for how you'll react if the market does shift direction.
I agree.
Speaking of plans, I want to circle back to Warren Buffett
Okay.
and his latest investment moves. I know a lot of people were scratching their heads when they saw he bought into Domino's Pizza.
Domino's, huh?
I mean, it's not exactly a Berkshire Hathaway type of company, is it?
Yeah, it's true. It was a bit of a surprise move, and it sparked a lot of discussion among analysts. Some were surprised to see him investing in a company that's faced some headwinds, from rising food costs and increased competition in the food delivery space.
But remember, Buffett is known for his long-term perspective. He's not looking for quick flips, but rather companies with strong brands and sustainable business models that can weather short-term storms.
Exactly.
And Domino's, despite the challenges it faces, certainly fits that profile. They've built a global delivery network, a loyal customer base, and they've been investing heavily in technology to enhance their online ordering and delivery experience.
I mean, who hasn't ordered a pizza from Domino's at some point?
I know I have. I think that's what makes Buffett such a fascinating investor to follow.
Yeah.
He's not afraid to go against the grain and see value where others might not.
He's a master at finding those hidden gems.
Now, Pool Corp, his other recent acquisition, is perhaps a bit more of an unusual pick, wouldn't you say?
It's definitely not as well known as Domino's. Most people probably couldn't even tell you what they do.
That's fair.
They're a leading distributor of swimming pool supplies, equipment, and related products. It might seem like a niche market, but it's actually a multi-billion-dollar industry.
Wow. I had no idea.
Yeah.
So what's Buffett's angle here? Why pool supplies?
Well, with interest rates rising and the housing market cooling off,
yeah.
some might wonder if it's the best time to be investing in a company tied to discretionary spending like swimming pools.
Yeah, that was my first thought too. It seems counterintuitive.
Right. However, Buffett might be seeing an opportunity in the fact that Pool Corp's stock has been relatively undervalued compared to the broader market. It's possible he's buying low, hoping for a rebound down the road when economic climate is more favorable.
So he's playing the long game as always. It's also worth remembering that Buffett has been sounding the alarm about market valuations for a while now. His recent moves could also be seen as a way to diversify his portfolio and reduce his exposure to overvalued sectors.
That's an excellent point. By shifting some of his holdings into companies like Domino's and Pool Corp, which are in different sectors and have potentially more room for growth, he might be trying to balance out his portfolio and protect his capital in case of a market correction. It's a smart move, especially considering the uncertainty we've been discussing.
Okay, so we've covered the U.S. and China. Now let's turn our attention back to Europe.
Right.
The Wall Street Journal reported that the European Commission has lowered its growth forecast for the Eurozone.
Oh, they're lowering it again?
Yeah, they've adjusted their projections. and it doesn't look great. They're now projecting growth of just 1.3% for 2025, down from their previous estimate of 1.4%. Now, it's not a huge difference, but it does indicate a continuing trend of slowing growth.
Right.
They're citing several headwinds,
Yeah.
including persistent inflation, geopolitical uncertainty stemming from the war in Ukraine, and the lingering effects of the energy crisis. It sounds like a perfect storm of economic challenges is brewing across the continent.
It does.
What's particularly concerning is that this slowdown seems to be affecting even the strongest economies in the Eurozone.
Like Germany.
You're right. The situation is especially concerning for Germany, Europe's largest economy. They're heavily reliant on exports, and the global slowdown is impacting their manufacturing sector, which is a key driver of their economy. And as we discussed earlier, the threat of new U.S. tariffs on European goods is adding to their anxiety.
Right.
It's like they're being squeezed from all sides.
Unfortunately, it does seem that way.
The Bundesbank president, as quoted in the Wall Street Journal article, has warned that a full-blown trade war with the U.S. could shave a full 1% off Germany's GDP.
Wow.
That's a significant hit for an economy that's already facing multiple challenges. That's for sure.
And it's not just Germany that would be affected. The ripple effects of a trade war would be felt throughout the Eurozone, potentially leading to job losses, reduced investment, and a further slowdown in growth.
Absolutely.
It's a scenario that European policymakers are desperately trying to avoid. They're urging dialogue and cooperation with the U.S. to resolve trade disputes and prevent further economic damage. But it remains to be seen whether those efforts will be successful.
Yeah, who knows with politics.
With so much at stake, you'd think cooler heads would prevail, but who knows?
It's hard to predict.
You're right. It's hard to predict the outcome when politics are involved.
Exactly.
But one thing is certain. The stakes are high, and the decisions made in the coming months will have significant implications for the global economic landscape.
I agree. It's interesting, as we've been discussing all these global economic trends and market movements, it's easy to get caught up in the numbers and the charts and forget that economics is ultimately about people. That's such an important point. It's about how these trends impact their lives, their jobs, their families, their hopes and dreams.
Exactly. A global slowdown, for instance,
Yeah.
can mean job losses, reduced opportunities, and increased financial stress for millions of people around the world. It can impact everything from their ability to put food on the table to their access to healthcare and education.
It's a sobering thought, and it reminds us that behind every economic indicator, there are real people with real stories.
Absolutely.
On the flip side, a thriving economy can create new jobs, boost incomes, and improve living standards. It can empower people to pursue their goals, build a better future for themselves and their families, and contribute to their communities.
It's like a ripple effect. Positive economic trends can create a virtuous cycle of growth, opportunity, and well-being.
That's a great way to put it. And that's why it's so important to keep that human perspective in mind as we analyze and interpret economic data.
I agree.
It's not just about abstract concepts. It's about real people and their lived experiences.
Well said.
Okay, let's bring it all together and consider what this deep dive has revealed about the current state of the financial world.
All right.
We've explored a lot of ground, from global growth concerns to trade war anxieties to Warren Buffett's investment choices to the potential impact of these trends on people's lives.
We've seen signs of both resilience and vulnerability.
Right.
In the global economy, there are certainly challenges ahead, but also opportunities for those who are well-informed, prepared to adapt, and focused on the long term.
It's like navigating a ship through uncharted waters. You need a steady hand, a keen eye, a good compass, and the flexibility to adjust your course as needed.
That's a perfect analogy. And one of the key takeaways from our deep dive is that information is power. By staying up to date on the latest economic trends, market developments, and geopolitical events, you can make more informed decisions about your investments and your financial future.
Absolutely.
Yeah.
So, dear listener, as we conclude this deep dive, we leave you with this thought-provoking question to ponder. Given all the information we've covered today, how do you think these global and market trends will impact your life in the coming months? Will you adjust your investment strategy, explore new opportunities, or simply stay the course?
The choices are yours, but we hope that this deep dive has given you the insights and perspective you need to make those choices with confidence. Remember, knowledge is power. Stay curious, stay engaged, and never stop seeking new insights.
And on that note, we'll wrap up this week's deep dive into the world of finance. Join us again tomorrow morning for a fresh look at the headlines from the major financial magazines.